5 truths about money your banks don't want you to know. Imagine this. One day, while reading your newsfeed at home, you come across an article that discloses a startling fact about money. Did you realize that the ability to produce money exists in every bank? Yes, even the Federal Reserve functions akin to a bank that prints money on demand. What if I told you, though, that you could accomplish the same goal? All you need is cryptocurrencies. You don't need to launch a bank or invest millions of dollars. Some people have even practically become crypto billionaires overnight. We're going to expose 5 financial secrets that banks have been hiding in this piece. Number 5. The pitfall of saving money in a bank. I would like to know whether you have ever questioned how much interest the bank pays on your savings account. You may believe it to be at least a few percent. Well, reconsider. Even the biggest banks, such as Citibank, typically have rather modest interest rates. Although some banks may provide higher rates than others, they are still not very good. The truth is that, over time, your purchasing power will decrease if inflation is at 7%, but your money is only growing at, say, 4%. Although it may seem like you're putting money aside for a rainy day, in reality, you're just allowing it to lose value yearly. In fact, rather than putting that money in a bank, you might be better off spending it now. In the end, banks aren't there to help you generate money. Instead, they're more like parking lots for your money. So be sure you know what you're getting into the next time you consider depositing your hard-earned money into a savings account. Number 4. Making new funds digitally. Banks indeed can generate money. Though that may sound absurd, bear with me. Although the only organization with the ability to print dollars is the Federal Reserve, all banks have some degree of money creation authority. You might wonder how. Let's say you deposit into your bank account. The bank wants to profit from it, so they won't just let it sit there. Thus, they charge interest on the money they lend to someone who wants to buy a house or a car. And what do you know? The interest rate that you pay the bank is frequently far less than that. How unjust. You may be asking how your money might be lent out by the bank while you still believe it is in your account. Fractional reserve banking can help with that. Only a small portion of deposits, typically 10%, must be held in reserve by banks. The remaining amount can be lent out. Thus, the bank can produce and lend out an additional $900 for every $1,000 that you deposit. That indicates that the bank manufactured $900 of the $1,900 total amount of money in circulation. Crazy, huh? Hey, it's just numbers on a computer screen, so it shouldn't be too hard for them to complete. Number 3. Taking out bank loans and putting money into successful businesses. The co-founder of Facebook, Mark Zuckerberg, spent close to $6 million on a luxurious home in July 2012, just 3 miles from his place of employment. And here's the thing, he didn't pay cash for it. No, he took out a 30-year mortgage. It sounds absurd, doesn't it? He's worth billions. If you could buy a whole lot of mansions outright, why would you even bother with a mortgage? The solution is straightforward: free money. Yes, you heard correctly. Free of charge money. I understand what you're thinking, though. Who in his right mind would give free money to a billionaire? That is insane. But please be patient with me. Interest rates are ultimately what matters. In essence, the money you borrow is technically free if the interest rate on the loan is less than the rate of inflation. That is precisely what transpired with Zuck's mortgage. His interest rate was slightly above 1%, and the inflation rate hovered between 2% and 3%. Thus, by simply borrowing money, he is effectively turning a profit. It sounds too good to be true, I know. However, here's how it operates. Suppose you take out a $1 million loan at a 1% interest rate. If you deposit that million in a savings account, which has an average rate of return of 2.4%, you will receive $24,000 annually. However, since your loan payment is only $10,000, you are essentially profiting $14,000 per year from your loan alone. And when you consider what you could accomplish with $100 million or even $1 billion, that sum is insignificant. Naturally, this tactic is only truly effective with substantial sums of money. However, when handling that much cash, a mere 0.5% variation in interest rates might translate into tens of thousands of dollars. Therefore, when you can use someone else's money for free, why tie up your own? It is a no-brainer. Number 2. You have to pay less interest the more money you have. Banks aren't exactly charitable organizations, as you know. They are all enterprises to become profitable. The shareholders, to whom they are answerable, are interested in earnings. Therefore, a bank will fail if it is not profitable. They so frequently feel more at ease giving money to those who already possess large amounts of it. For example, the bank won't worry about losing sleep over lending you money if you're a billionaire. They are aware of your financial capacity to reimburse them if something goes wrong. For someone who is having difficulty making ends meet, the situation is not the same. Taking out a loan while you're living paycheck to paycheck is a significant risk for the bank. After all, they're not in the risk-taking business. To be clear, I'm not saying this to support banks. However, you must consider things from their viewpoint. Let's say you had a friend who needed a loan. Which friend, the one who's barely making ends meet, or the one who has a reliable job and a healthy income, would you feel more comfortable lending to? Surely it's not an easy choice. All banks want is to manage their assets prudently so that they may continue to make money down the road. Having said that, you must strengthen your financial position to get the best rate with a bank. Wealthy individuals and asset owners are preferred by banks since they are less likely to fail on their loans. Therefore, you'll be in a lot better position to secure a favorable offer from a bank if you can increase your savings, pay off some debt, or invest in something that brings in money. Number 1. Credit cards resemble an arsenal of powerful weapons owned by banks. Did you know that this year 70% of Americans who owe money on their credit cards won't be able to pay it off? That is a large number of people who are in precarious financial situations. Consider this: you do not pay a modest amount on your mortgage each year like you do with credit card debt. Yet interest rates on credit cards can reach up to 20%. If you're already having trouble making payments, things will only become worse as the debt accumulates. Regretfully, a staggering 56% of individuals polled said they had credit card debt for at least a year. Even worse, the majority will have to put up with it for years to come. Approximately 20% of respondents believe they will need more than 3 years to pay off their debt, and 8% are unsure when they will be debt-free. The most detrimental aspect, because banks profit greatly from interest, they thrive when customers get trapped in the debt trap. Avoid falling for their enticing new credit card offers. Although credit cards are a terrific way to establish credit, you should avoid using them if you are not financially responsible. Remain debt-free by living within your means and only making purchases that you can afford. There are financial secrets kept by banks that their clients may find pricey. First of all, banks' primary purpose is to store customers' money. They are not meant to assist them in making money. Second, it is unjust for banks to charge borrowers more interest than they pay depositors, since they can produce money electronically. Third, rich people can borrow money at interest rates below inflation from banks and use it for productive investments, thereby making the loan interest-free. Although these realities have the potential to bring about the collapse of the banking system as we know it, knowing them can help people make wiser financial decisions. So this is the end of our today's video. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.